Investors are following the mining, and markets have been through the ringer when it comes to movements in this particular space. So if you look at just some of the share price movements, the JSE's resources top 10 has fallen 23% since May, with companies like Glencore down 18%, BHP Billiton down 15%, and Anglo American down 17%. But in studio with us to take a look at the outlook for this particular sector is Jason Muscat. He's an economist and industry analyst at F&B. Jason, thanks for your time. So I asked Yana what the big issues were in mining. She said it's very much still a China story. Let's unpack that. Let's look at the different factors. And yes, we're going to go back to China. How big of a factor is it?
China's a massive factor. I mean, they are the primary uptaker of a lot of the commodities that South Africa produces and exports. And their growth has slowed from around 14% year on year to around 7%. Now, even 7% is not a bad number, but what we've seen in commodity prices, sort of halving of a lot of these prices, suggests that growth in China is worse than 7%.
Other factors to consider, though.
Well, take your pick, really.
Let's start with the US. A rate hike definitely coming, and that's going to have an impact.
Yep, absolutely. Fed Chair Janet Yellen said that looks like there's a rate hike on the cards in September. So that's certainly going to put additional pressure on the commodity producers, as well as China's growth. Domestically, we also have significant challenges, load shedding being one of them. We've got quite a fractious labour environment, and there's a lot of distrust between labour, between government and the private sector. And ultimately, where we are at the moment, there's just no winners.
Can I jump in there? I mean, with the rand at, what was it, 12 rand 75 before we came on air, surely that does give us a little bit of a breather, though, from a South African producer perspective.
One would assume that, because when you translate back into rand, it makes the commodity prices look a lot more attractive. The problem is, though, that it's a double-edged sword in that, you know, the input prices also become a lot more expensive. So while the rand has weakened, it hasn't done enough. You would hope that the commodity price too would lift. So they are selling at the same rate as before, but they're also seeing significant escalation in input costs.
While we're seeing this US dollar strengthen, let's take a look at some of these commodities, and maybe starting off with gold, the gold producers.
Sure.
It looks as though that 1,000 mark is coming, or below 1,000, and it's coming very quickly. If we look at specific commodities, what is the outlook? And maybe are there ones that are in a far less off position than, let's say, the gold and platinum stocks?
I wish I had a better answer for you, but unfortunately there just seems to be nowhere to hide. Let's unpack platinum quite quickly. Platinum is used in catalytic converters, and if we look at vehicle sales in China and in Europe, they're starting to slow quite significantly. Domestically, we've got our own issues in the vehicle market. So the demand for platinum is not there. We saw a 6-month-long strike where one would have anticipated that all that production being offline, commodity prices would have increased, and that simply didn't happen. So there's a lot of excess inventory in the system at the moment. You spoke about gold, and gold trading at about 10.88 this morning. So, you know, there's a lot of pressure. A lot of these commodities have halved, and you have additional constraints such as low-cost producers of iron ore just ramping up production. And in an environment where commodity prices are taking such a hammering, you'd expect them to cut back on supply to try and raise the prices. But they're also trying to push low-cost producers out of the market at a time when demand is just not there. And, you know, even though we've seen commodity prices come off 50% and more, we haven't necessarily seen the bottom. I think a lot depends on what's happening in China. And if we think about commodity prices as potentially being a better reflection of the Chinese economy, we can also look at what's happening in the Chinese equity markets. I mean, we've seen an 8.5% sell-off on certain days. Chinese government is starting to intervene. But all in all, the signs are negative. And unfortunately, there doesn't seem to be any immediate light at the end of the tunnel.
Ayana, just before you jump in there, you said we just have to look at the commodities market and the performance of these companies to see that China maybe is struggling. The numbers that have come out, is this just again solidifying that there is a contradiction between, you know, GDP numbers that we get from China versus what is actually happening in that real economy?
It's very difficult to say with any certainty. The Chinese government is very strong in terms of being able to stimulate economic growth. So they might set a target of 7% and then try and stimulate that growth through rate cuts, which is what they have been doing. The problem, though, is that commodity prices have fallen far faster and far deeper than the economic growth rates suggest. So to say that it is not a fair reflection of what's happening on the ground is probably a bit of a stretch, but there does seem to be underlying weakness within that economy. And certainly Chinese equity market is sort of reflecting that too.
I think it's interesting because we always look at this from the point of view of China not buying our stuff or as much of it, our commodities as they used to. But I think what's happening in the steel industry is showing an interesting side of the reverse of that, where suddenly they're sitting with all this excess steel capacity, for example, and if you believe the local steel makers dumping it here. And I think it's going to be an interesting adjustment for the world economy to look at to deal with a China that's no longer as dependent on infrastructure investment as it was maybe in the 2000s. So I think it's going to be an interesting time to see how it all plays out.
I think maybe just to pick up on that and throw it back to you, Jason, we've seen trends with particular companies cutting back on capital expenditure. Steel industry saying they need more import tariff support. Shell yesterday out with numbers, pulling back on capital expenditure, job cuts. Are they doing enough?
I think they're doing the best they can in a very difficult environment. You certainly don't want to be investing in growth when there simply isn't a market for those commodities. And with oil sitting around $53 a barrel, we've seen a lot of the drilling guys take production offline. The drilling rigs have been declining in the Gulf. So a lot of these mines we see locally are being put on care and maintenance. That's one way of trying to shelve your capital expenditure. But more than that now, these mines are actively being sold off. And that shows the depth of the problem. And obviously the repercussions for the South African economy are enormous. I was looking at the numbers a little earlier. In 1990, the South African mining industry employed about 900,000 people. Today, it employs just over 400,000. We spoke about the dependence that each miner potentially has. So the knock-on effect is quite dramatic, and it feeds through into the manufacturing sector too. Now, in an environment like this, where we have a weak rand, ideally we'd be expected to ramp up output so that we can continue to drive exports and bring foreign exchange into the country. Now, with the demand not being there, we're not able to do that. And it's further compounded by some of the fractious labor issues that we're currently facing, gold mining being one of them. And also load shedding, which has put severe restrictions on the productivity of these mines.
They say that mining moves in cycles. We're clearly in a downward cycle. How much longer, in your personal opinion, and obviously being an economist and an industry analyst and looking at this, how much more further do we have to go until there's some sort of recovery?
That's a very difficult answer. And I think the key here is to watch out for what happens in the Chinese market. Will the Chinese government be effective enough in remedying what we see in terms of their declining growth rate? And also, more broadly, what's happening in India? India's an economy where we are starting to see significant reforms, and we are hopeful that starts to bolster their GDP growth. If that happens, we might start to see a bit more of a bottom in commodity prices as India starts to supplant China as the uptake of South African commodities. That, however, is not necessarily going to be the case. China is an enormous economy. India is still finding its feet, very much a powerhouse in the making.
Yeah, no, I think one of the points that I think Mark Tafani also made is if you can stick it out in the longer term, the prospects, of a consumer-driven economy in China is actually good for companies like Anglo, where they have big platinum and diamonds, and those are things that they see demand growing in the future. But I think the key is going to be to see how companies cope with the next few months. And I think Goldman Sachs in a recent report said, companies are not doing enough in terms of asset closures and sales and retrenchments, and they expect that next, by the end of the year, if things don't look up in terms of demand and pricing, that we'll see substantial restructuring of companies early next year. So it will be an interesting space to watch.
Yeah. Just the final one, the oil situation, oil price. A lot of factors here. We've got excess supply, and the wild card, Iran, might come on stream. So this is going to add further pressure, you think?
Absolutely. They are a significant producer of oil. We've seen restrictions being lifted after the nuclear deal was signed. They could bring additional capacity online as they need to start bringing money into their economy after years of isolation. And what that would do is sort of put further downward pressure on the oil price. That's fantastic for South Africa. It might just be the reprieve that we need in what is a very difficult economic environment. But for people in the oil and gas industry, again, that's going to put pressure on employment levels.
Hard times, leaving it on that very glum note. Thank you so much. This big thank you to Jason Muscat. He's the economist and industry analyst at FNB. And of course, Yana Murray, FinWeek's editor.